What's going on, guys? This is Ian Starkey with White Wave Capital, and I want to do a really quick video of a property I'm analyzing right now. So I'm going to share my screen with you guys. So this property is actually an A-class asset, something we don't normally touch or look at, but we like it. We like it. It makes sense. Our property management company likes it a lot, so we're going to take a look at it. So I'm actually about to go walk it here in the next 30 minutes, but I want to put this video together to show you what we are looking to offer on it. So I've gotten all the financials. I've gotten all the numbers from the broker, the rent roll, trailing 12. I got their pro forma, and then I got our pro forma, which is, I think, a little more realistic. And I'll show you guys how I make my pro forma and how I will tweak it and edit it to see what's going on. So as it sits right now, if we were to put this deal together, we're going to offer them $7.26 million, comes out to $121 a door. Estimate 4% on closing costs. That's for broker fees, syndication fees, just any legal, all that fun stuff, all that jazz. Operating account, keep 100 grand in the operating account. If you want to follow my mouse here. So our loan amount, spoke with our lender. They said they'll do 75 to 80% of an interest-only loan, which actually could work for this deal. It'll have to be interest-only for the first 7 years. Otherwise, it's too expensive. So doing that comes out to a $5.8 million loan. I found that by calculating our purchase price times 0.8. So that is our LTC, LTV, 80% at 4% interest rate, interest only. So let's talk about this right here. So whenever I'm analyzing deals, I'll usually start and end here. This is very important to me because this is what our investors are going to be getting. So right now, this deal is structured as a 70% ownership to investors. So ownership to investors. So 70% of this deal right now is going to our investors. That means they'll be getting 70% of the cash flow, 70% of sale profits, 70% of the pie, basically. So at that, they'll be making about an 18% IRR per year, about a 25% average return per year. That's including their equity, cash flow, and sale proceeds at the end. So that's how that number comes together, is a 25%. It's not bad. So that's why I like it at 7.26. They want $8 million for it, but when we do that, that's $133 a door. That just doesn't make it very attractive. It still works, but I'm gonna hang out with the broker and talk to him today whenever we walk through it and see what they think about 7.2. So yeah, so that comes out to their equity multiplies by 2.5%, 2.50, 2.5x. So it's pretty sweet. 10% average cash flow per year. The total investment is, they get a 275% total return on their investment. So this I'm going to check on because that may or may not be a little skewed. It's a huge return over 7 years, and it's a great investment if we can do that. So yeah, their total compensation from this deal, based on our 7-year plan, our investors will make $5 million total, and that's based on, right now we need to raise $1.8 million of equity to close this thing. That's the difference between our loan and our cash to close. So we'd be all in. If we offered them 7.26 with closing costs, operating account, we'd be all in for about 7.6 million. So yeah. So over 7 years, we're estimating we'll make about 5 million. So, and that's not including the 2 million. So that's, at sale minus 2 million, we'll have 5 million to distribute to our investors. So it's pretty sweet. So let's go down. Let's get into it real quick. So right now, this tab right here is our current rents. They have 24 1-1s, 36 2-2s. Pretty good size units. The 1-1s are 281 square feet. The 2-2s are just over 1,000 square feet. Their current rents are just under $1,000. Literally $9.99 is what they're renting for. It's probably some kind of rent special for the 1-1s, and then $12.97. I mean, it's a hot market. Interest rates are rising, and a lot of people are moving into A and B plus assets. So I think we can come in and raise these rents over the first year, about 25 to $50 So our pro forma, we have our 1 bedrooms going up to 1,025, our 2 bedrooms going up to 1,350. We're always looking to raise the rents. We're always looking to do some value add, improve a property. We also have awesome property managers, property management company. So those are the guys who make it happen. But yeah, so right now the property currently makes about 800. Just with their rents, it can make 848. It really brings it about 785 due to their collections and vacancy, and then with their other income. So their collections aren't stellar, but they're not terrible. And their vacancy. So after that, they bring in about 735. They have some other income, auxiliary income, whatever you want to call it, about 50 grand. So our goal would be to improve collections of vacancy to 8% for both those categories. And I can specify those and get specific with those. But basically, we'd look to improve that a lot, as well as the rents. So look to bring in gross rental income about 809,000, and then our other income, well, I'd want to raise that a little bit. I know there's some ways we can squeeze some more juice out of this lemon and raise that about 5,000, 54,000. Their expenses are pretty, it's a pretty decent expense ratio. It's high because of their rental income and their collections. Their expense ratio is about 51%. So, we improve ours to about 44% and lower the expenses a little bit, get a little more efficient in some areas. So, overall, after all expenses included to operate the property, we look to raise it by about 85,000. So, from 397 to 42 take home. Then we move down here. So, this category is very important to me. A lot of operators, a lot of syndicators will often over speculate their income growth. I ran it really conservatively here with a 1.5% income increase per year. So that means we're going to be looking to increase the income by 1.5%, increase the rents by 1.5% per year. Realistically, I could put that a lot higher. So, I could put it at 2% across the board. So before I do that, I want to show you guys how much of a change that makes. So 1.5%, that equals, 18% IRR, 25% average, 10% cash on cash return per year, average cash flow. If I put that up 2% a year, still considered conservative, and put that all the way across every year, we want to raise it by 2%, which is a little aggressive, but it's achievable. Greatly increases. We come out to a 20% IRR, 28% average, and 11% cash on cash. So 2% would be sweet. I like to be realistic and conservative, maybe a little too conservative sometimes, but I'd rather underplay myself and impress people on the back end than the inverse of that. So yeah. For this one, because we're taking so little equity as a general partnership and we're going to have to manage this thing, we're taking a 2% asset management fee. Comes out to $17,000 a year. Not much. Keep the lights on, pay for my gas and travel to and from the property. Then also really pay for the property manager's lunch, events, stuff like that. That's really where the asset management fee is going to go here. Basically, our investors will make about 180 grand that first year, 190 grand the second year, 200 grand. They're making around 200 grand a year from this property from the cash flow, as long as we hit our metrics. They want to sell it to us for a 4.9 cap for $8 million. That's really pricey. Granted, it is a 2015 build, but we're looking to, for the price we're looking to buy it at, which is 7.2 million. We'll be buying it at a 5.5 cap, 5.47. Still pretty much buying at market, but we're making a lot of money here. We're making money, so that's how. That's how we found that number. I'd love to buy it cheaper, but I don't think we'll get an offer accepted if we go much cheaper. So another thing that goes into my analysis, because we're looking for a 7-year hold strategy, we're looking to sell it at year 7. So I do an increasing cap rate. I have the cap rate increasing by 10%, 10 basis points. So, by year 7, sell at a 5.6 cap. Now let's actually change this to show what we're buying it for. So that was based on the purchase price they want. Let's put it the price that we want. So if we get the price that we want, we'll actually be selling it at a 6.1 cap. 7 years down the line, still same returns, but we'll be selling at a 6.1 cap. While it is a 2015 build, while Houston is one of the hottest multifamily markets in the nation, I still don't like to think that the good just keeps getting better. I think there will be a correction or two within these 7 years, and I don't think cap rates are going to keep compressing. That's just me. I'd love for them to keep compressing with the assets I'm buying, but I want them to increase on everyone else's so that I can go buy them. So yeah. So based on $100,000, okay, let me not skip ahead. So our debt yield isn't great. Our return on investment is awesome, 14%, 15%. It's based on the cash flow. Return on equity, 7%. Our equity in the property grows each year pretty substantially, 82%, 100%, 100% growth. This is what's important to me. So the occupancy for break even is 61%, pretty much throughout 61 up to 62. So that's solid. In order for us to lose money, we'd have to basically shit the bed and only get this thing filled up to 60% in order to make no money on it. So that's a really healthy number at 60% for our break even. Right now it's at 90%. And as long as we get our management team in there and they do what they do, that won't be an issue. So then based on $100,000 investments, that partner that invests $100,000 year one, they'll own 3.8% of the deal. So they'll get 3.8% of the cash flow, which per year, that's $9,000 for year one, $10,000 year two, $10,008 year three, year four, year five, year six, year seven. It just keeps increasing. So, as we pay down the basis and we increase the rent roll each year, that investor is going to, earn more money each year from the cash flow. So year one comes out to about a 9% return. Year two is 10%. Year three is 10%. That's the cash on cash return. The 5-year IRR is 19%. It's a little higher than the 7-year IRR. And the reason why that is, you see 5 years 19, 7 years 16, 5 years 23. That's because of the cap rates. Because I have my cap rates increasing, that actually means that we're going to sell it. I'm projecting we'll sell it for less money in year 7 than what we could sell it in year 5. Because if we're selling this thing at a 5.9 cap, our sales price could be at a 5.9 cap. If we sell it for that, we'll be selling it for $9.1 million. If we sell it for a 6.1 cap, we're selling it for $8.9 million. So even though we're selling for less, we're still making money. Let me show you that. So here's our sales assumptions. So basically our sales price, year 5, like I said, selling it for $9.1 million. We have a broker involved. We don't charge, my group, we don't charge a disposition fee. We charge an acquisition fee. Sometimes a management fee. We take less equity. And that's it. That's the only fees we charge. We're not going to charge a dispo fee as much as I'd love to. That cuts into your returns too much. And we're here to make everyone money. We want to make you money. As long as we make you guys money, we'll continue to make money. We'll continue to be in business, and we'll be able to buy more properties and continue to fulfill our mission. So yeah. So estimated about a 3% broker fee. That could be higher. That could be 6%. But we'll estimate 3%. Loan payoff. So in year 5, we're estimating about a $4.8 million loan balance. Once we pay that off, we'll have $3 million from the sale proceeds, basically to pay our investors back any money we haven't paid them already from the equity raise. That'll be about $853,000. So once we pay back that $853,000, then we start splitting up the pie. Then we'll have $3.1 million to split up, to which, based on our equity, 900 of that will go to the sponsorship group. My team and I, 2.1 million will go to our investors, and that's solely based on the equity. So because our investors own 70% of the deal, they get 70% of the profit, we get 30%, and if it was inverse, it'd be the same thing. So investor proceeds from the sale are 3 million. The multiple is 1.6 multiple. Our total returns for our investors at 5 years is 4 million. 7 years, it's higher because there's less debt to pay off, and a little bit more sale proceeds because there's less debt. So yeah, a refinance. I don't know if that'd be possible with this kind of deal. It's showing that we'll make a little bit of money from a refi in year 3, so that is an opportunity. There actually is an opportunity with this deal for the seller to carry back 10%. So we could look to do that and pay them off in year 3. But yeah, so that is my analysis of a deal that I'm going to go look at today. I want to share it with you guys, share with you kind of how I break things down, how I'm thinking, what my thought process is. Because whenever we look at these deals, I'm looking at how we can make it work and how we can kill it. So one way to make it work is give our partners more equity. One way to kill it is to also not increase the rents at all. So let's say we increase the rent by $1 there and by $1 here. No rent increase. Now what happens? Now not as good returns. 9% cash on cash. 4 million total proceeds. I mean, it's just it's a calculator. And my brain's like working like a calculator because I'm like, okay, how can we make this work? How can we make it work? How can we kill it? So, yeah, that was a quick analysis of a deal I'm going to go walk in the next couple hours. I will be posting on some social media some short stories about the property. No addresses, no names, because I'm under an NDA and because it's still on the market. But yeah, thank you so much for watching, and for all of our future opportunities, check out the website, fill out the questionnaire, and we'll be in touch.